My pleasure to welcome Quipt Home Medical to the stage. CEO and Chairman Greg Crawford, welcome, Greg. And yeah, the stage is all yours, Greg. Looking forward to the presentation.
All right, thank you. Thanks everybody for participating today. So Quipt Home Medical is a full service respiratory provider. We primarily provide respiratory products to patients in their homes. All of our operations are based in the US. We're currently in 15 states with over 60 locations, and we deliver over 250,000 pieces of equipment annually to over 150,000 active patients. How we get our business, and that I like to refer to as the order life cycle. We have boots on the ground sales representatives, and they call on call points such as physicians' offices, hospitals, long-term care facilities, physicians' offices, anyone that would be discharging a patient to the home setting for additional care. Once the need is established, they will contact one of our local service centers. They will send over the proper prescriptions and medical documentation. The customer service team will work with the insurance companies to obtain benefits and any pre-authorizations or predeterminations as needed. Once payment is secured from the insurance company, it goes over to our distribution team. Our distribution team consists of registered respiratory therapists, nurses, patient service technicians, and they will either go out to the patient's home or the patient will come into one of our offices. We'll get them set up on the device, and they'll also provide all of the education and all the ongoing support and monitoring for the products. Once the product is set up and the patient's utilizing it, it gets turned over to our revenue cycle management team, and they process all the billing for the subsequent months of rental for the devices. We have a very strong and growing recurring revenue model. Approximately 75% of our revenue is recurring and 25% is sales. That product mix is around 80% respiratory and respiratory services, and oxygen therapy is approximately 23%. Sleep therapy devices is around 21%. Sleep therapy supplies, the patients are able to get 3 to 4 times a year based on their insurance coverage, is approximately 19%. Our home ventilator program is approximately 17%, and then our basic home medical equipment and mobility products round out at about 20%. We also have a very diversified payer mix, with Medicare encompassing around 40% of our overall revenue, private insurance around 38%, the state Medicaid programs at around 12%, and then our private and patient pay coming in at just over 10%. Some company highlights is our utilization of our technology applications throughout our organization in order to remove a lot of the friction points to order equipment, and also the remote patient monitoring features of our equipment. Once again, that subscription revenue model at 75%. We operate in a market that's expected to be $84 billion by 2028 and is about ready to breach the $60 billion market. But also at the same time, we operate in a very highly fragmented market with over 6,000 quote mom and pop type providers out there, as we have a very active acquisition focus as a part of our growth strategy. Right now, we believe that we're in one of the best regulatory environments that we've been in well over a decade. We have several tailwinds that are kind of propelling us through that. One is the cancellation of 13 product categories for the competitive bidding program that's been around since 2010. Those products were removed from this round of competitive bid in 2021, which was essentially everything that Quipt provided to Medicare beneficiaries. And the reason they were removed, and that is really key, is that Medicare had made a statement and said that they did not achieve the expected savings. And in fact, when the rates were published in early 21, some of the major metropolitan areas, and that should have the program been implemented, would have seen an increase in reimbursement rates of anywhere from 40 to 50% on certain product categories. So we believe that reimbursement rates have hit a floor, and we've got a clear margin outlook for the foreseeable future. Most recently in April of 21, we did receive an increase in one of our major product categories, and that being home oxygen therapy. That's another good tailwind we've got with the regulatory environment that we're in. And also most recently, there have been some changes to home oxygen therapy qualifications to where they're going to start covering it for acute diagnoses. And also they've removed some of the burdensome paperwork that's required in order to get patients set up on the equipment. Just some industry dynamics here. We're definitely a demographic play with 10,000 people turning 65 or older every day for the next 15 years. That's our core market. The industry itself is growing at about 5 to 6% a year. We've been growing at almost 10% in that over the past couple of years. Year to date, and that through our fiscal year, which ends 9/30, through our 6/30 reporting numbers, we were up about 11% organic. Some of our strategic growth initiatives on a go-forward basis is a three-prong approach. One is through organic growth, the second is technology implementation, and the third is acquisitions. On the organic growth side, we talked about the demographic play with the aging population in the U.S., also the utilization of home oxygen, and that even prior to the pandemic, and that has increased 15% over the last 5 years for the prescribing of home oxygen for COPD patients. Also, the number of patients suffering from 3 or more chronic diseases is expected to increase 171% in that over the next 10 years or so. We believe with our diversified product portfolio that we're set to capitalize on that organic growth. The second is technology implementation. With this industry being so highly fragmented, we have not seen much in the way of technology implementation. Quipt has invested over the past several years, and that significantly in our infrastructure. And it really all starts in that with our technology platforms in order to order equipment, and that via portals that allow physicians, hospitals, or anyone else, healthcare professional that would be ordering equipment, and that to order that equipment seamlessly removes a lot of the friction points and allows us to gather all the proper information that's required by the insurance companies. Really that, along with our data analytics and our remote patient monitoring, has allowed us to remove those friction points on the workflow processes, which has helped accelerate our growth and also accelerate our replenishment of our disposable supplies. A second piece of our technology platform is our telehealth platform. We hear a lot about telehealth right now with the pandemic ongoing. We've had a telehealth platform for over 3 years now. So that continues to see high demand in that for utilization of our telehealth platform in order to get our patients set up on our equipment. The third piece in that is our remote patient monitoring features, and that for our ventilation and our sleep therapy products. We've been able to create a totally connected healthcare platform for our patients, our payers. The benefits in that have been across the board in that for all parties involved, we've been able to encourage compliance and drive better patient engagement and reduce hospitalizations with our remote patient monitoring features of our equipment. The second is our acquisition strategy. Right now, in that with our 3-tiered acquisition strategy, we've been looking at companies in that, and most recently we've acquired in 2 of our 3 components of our acquisition strategy. One would be looking at sub $5 million companies as we've looked to expand geographically and enter into new states. We've had around 9 acquisitions that kind of fit that criteria to date in that this year, and we've entered 5 new states. The second would be heavily weighted respiratory type companies in the $5 to $20 million range. We've most recently announced 2 LOIs for a total of $27 million worth of top line revenue. The third would be targeting substantially larger acquisitions with revenue in the $30 to $60 million plus range. We believe with where the market sits right now and the activity that we've seen in the market, also with our pristine balance sheet and our liquidity, which we have over $50 million with over $30 million in cash and a $20 million untapped bank line, that we believe that one of those acquisitions could be in the future for us. The second piece is our acquisition integration with our proven integration strategy that we've been able to prove over the past several years with creating the infrastructure that we have right now. We have been very successful at integrating companies onto our platform. On a post-acquisition basis, we typically tend to get 1 to 2 turns of EBITDA once we get them fully integrated onto our platform. And some acquisition summary here. Over the past several years, we've been very active this year with a total of 11 acquisitions. To date, you can see there that we're seeing purchase price go anywhere in that from about 40% of revenue to just over 1 times revenue, or another way to look at it would be anywhere from about 2.5 times EBITDA to 5 times. That's prior to any synergies in that we would see once we get them integrated onto our platform. Our strategic growth initiatives has resulted in our aggressive growth trajectory that we're on right now. Our current run rate is $115 to $120 million as we enter our fiscal Q1 22. Calendar year in 22, we just updated our outlook with our 2 most recent updated LOIs that we announced. We've got calendar year in run rate of $180 to $190 million in top line revenue. We think with the balance sheet that we have right now and our line of credit and our ability to increase our line of credit, which we are actively working on, that's going to be pretty easily obtainable. Over the past 2 years, we've reached our outlook in that 1 quarter earlier than expected in each year of 20 and 21. 3 to 5 years, 325 to 350 million plus in revenue. Some financial information. Once again, we report on the fiscal year, which ends 9/30. So we've reported through June 30th for comparisons, and that for Q3, 26.2 million for 21 and adjusted EBITDA of 5.3 million. Quarter over quarter, 8% increase in total revenue. I think year over year is kind of really paints a picture of where we're headed. 41% increase in total revenue and a 21% increase in adjusted EBITDA as we continue to build on our scale, with 7% of that being organic revenue growth. Q3 year-to-date 2021 results have been $73.2 million in top-line revenue and $15.9 million in adjusted EBITDA. Year-to-date, that's a 38% increase in total revenue and 11% of that being organic growth. Also, we've been able to reduce our bad debt expense during the same period. We've been able to take that down from 10% down to 8% during the same time period. Our adjusted EBITDA margins continue to remain strong right there, just above that 20%, even as we continue to acquire companies. Our capital structure and inside ownership, as we sit right now, we got a very tight share structure with just over 33 million shares outstanding. The only real debt we have right now is a convertible debenture for about 11.6 million dollars Canadian. We've got that over 30 million of cash on hand, and then we've got our untapped revolving credit facility for 20 million, which we most recently announced in a press release that we're working through a term sheet right now to increase that line to up to $100 million. Management and the board is fully aligned with our shareholders. We own about 10% of the shares on a fully diluted basis. Just got a comps table there that's available in that on our website that you can kind of go look at to see where we're trading at. As far as the management team, myself, I've got over 25 years of healthcare services experience and been in the DME industry that entire time. I came to Quipt via selling my private business. Shortly after that, I took the company through a restructuring, and after that was completed, I became chairman of the board and CEO. Hardik Mehta, our CFO, has been with the company in that on a consulting basis since 2016, and in 2018 became CFO. Hardik's got an extensive background in data analytics and M&A transactions, and Hardik runs the day-to-day of our M&A along with our accounting department. Tom Rurik, our EVP of Finance, has got over 30 years of hands-on experience in accounting and finance. He's responsible for our audit and all of our public filings. Our board of directors, we have 3 independent directors. Mark Greenberg's independent director. He's got over 30 years of investment banking experience. He advises the company on all its M&A transactions. Eugene Ewing's got over 30 years of accounting experience. He advises the company on all of its financial statements and is also chair of the audit committee. Dr. Kevin Carter is a board certified sleep physician. He advises the company on all of its clinical protocols. And most recently, we just commenced trading on the NASDAQ on May 27th, 2021. And that is the end of today's presentation. Thanks everyone for participating.